What's up, YouTube? I am going to be making a few videos of the playbook that I trade day in and day out. This playbook has made me profitable, has made me consistent, and this playbook is taking me towards that 8-figure trader that I will be. I take these trades every day. I look for them in the market. You know, obviously they have to line up with the higher time frame confluences and the confirmations, but these are the trades that have changed my life and that will change my life. And these trades will be these types of trades, this playbook will be the reason that I become financially free here in the shortcoming. The first entry and playbook trade that we have is called the breakout. What the breakout is usually it's mostly during consolidation. And what consolidation is just ranging. This, you know, you had usually after a big drive in the market, whether it's to the upside or the downside, depending on, you know, price action, price will consolidate because price needs to gather its breath. It just sprinted up this hill, and so it needs to gather its breath. And what price is really doing is just grabbing orders, stopping out people, the inexperienced traders, the FOMO. It's making all this liquidity be gathered before it makes its decision on where price wants to go. This is just liquidity being grabbed. Millions and millions and millions of dollars being grabbed in this area. Why? Well, because price is overextended, meaning it just needs to catch its breath before it continues to the upside to go retest the highs, or maybe we break down below to go retest the lows that were created. So what the breakout looks like is you get a closure above. The higher the time frame, the more probable that price will go in that direction. You can't avoid fake outs, but you can help yourself by not getting in trades where fake outs may occur, and that will be another video that I create and we go over. So what the breakout looks like is you have a bullish candle close after this range. You have a bullish candle close above the range, and like I said, the higher the time frame, the more confluence. What you want to wait for is for this candle to close. You're not getting in on the break of these highs or these highs right here. You're waiting for confirmation. This is your confirmation candle, meaning if this candle closes on, say, the 15-minute, the 30-minute, or the 1 hour, then you can get in only if this, then that. You need to look at the market as a business. Is this going to be a business expense that I am okay with losing? And if this, then that, meaning if we get a bottom wick, which a bottom wick is a bottom wick that's tapping into this range. So if we get a bottom wick tapping into this range, because 85% of candles will create top and bottom wicks. It doesn't have to be the current candle. If we get a bottom wick tapping into this range, that gives me room for a stop loss. Because if I get in on the trade, if I get in on the break of these highs right here, say I want to get in on the break of these highs right here, I need a stop loss. And what I mean by that is I need a stop loss because my account can't afford to have a stop loss clear down here. So what you use is previous candle highs, current candle low, or back in the range, obviously, to give your trade room to breathe. But this acts as a stop loss. The impatient people will get in without the bottom wick. And like I said, 85% of candles will come up and create top and bottom wicks. It doesn't have to be this current candle though. Say price decides to move without a bottom wick, so it looks something like this. Say price, you know, new 30-minute closure. Say price just moves up without a bottom wick. More than likely what you're going to see is, because it's a higher time frame closure, more than likely the next candle will break the highs and then come down to go create that bottom wick on that previous candle right here before making its decision on if it wants to continue bullish, or are we going to close back in the range and we're going to have a fake out, something like this. That's that's most likely going to occur. So that's why top and bottom wicks are so important. So that's why the patient trader gets paid, why the impatient trader loses. This game's, it's a game of patience. So with that being said, you need to wait for a top and bottom or a bottom wick in this instance, because we are bullish, we are breaking out of this range. Another nuance that I look for is after you get your bottom wick, you obviously, after you get your bottom wick, you obviously want to wait for a high to be created like this, and then you get your bottom wick. Now you have a stop loss and you can get in on the break of the previous highs, but you always need to look left to get right. And what I mean by that is you need to identify areas that you are going to manage this trade. And what I mean by that is you will always find areas where price rejects out of. Say we were consolidating, or we planted a support right here. It looks something like this. We planted a support in price. For some reason, this imaginary line price drove up from. So this is consolidation, and it looks something like this. We were in a range of maybe we were in low times of volume. Not sure. Don't really care. But what I mean by that is you need to identify by looking left where price may want to reject out of, and use those areas as areas of interest for your trade. And what I mean by that is now you have this resistance here or support depending on market structure. I'm looking to either go break even here, I'm looking to close full, or I'm looking to close partials, because I am a scalper. I don't want to be in this trade. And if price rejects out of here, especially because I trade gold is very statistical. It will bounce off of respectable areas of interest. So I'm looking to have my take profit closing 50% or even going break even right here. I'm always looking left to get right. So that is how you manage your trades in situations like that. You don't just hold, because that's not how price action works. Price action will create higher highs and higher lows. So if you hold this trade, there's a good probability that you will hit break even, or you will even get stopped out, because the next candle, because we are overextended, the next candle more than likely going to break the highs and it's going to come back down. And then because we are bullish, all these buyers are getting stopped out because they held when you could have closed full at this area of interest or even gone break even. More than likely price is going to come back up to your area. But think about it, this is like an hour later. I don't want to be in this trade for an hour. I'm a scalper. I'm trying to get in and out of this market. So that is how you manage breakout trades. There's a couple nuances in which that will keep me out of a breakout trade. One of them is you need to close, because I said 85% of candles close or will create top and bottom wicks. If this candle right here closes with a nipple wick to the upside because we're bullish, or no wick, I will not be interested in this trade at all, because a lot of times price will reject and there'll be a fake out, because wicks create ranges, and when there's no wicks, there's nowhere for price to go. It's confused, it's lost. So a lot of times you'll get something that looks like this. You'll get a fake out. You'll get, maybe this current candle that I'm drawing will create the high for the previous candle, and you'll get something like this. Price will fake out, and next thing you know, we are off to the races to the downside to go retest this clean move that happened to the upside. So no wick, no entry. Another nuance is if we're overextended. And what I mean by that is, say this candle right here at the bottom of this range, how to tell if a candle's overextended is always look at where price is coming from. So if we're at the bottom of this range and this candle that I'm drawing closes above, I will not be entering this trade, because if I can't get in at the bottom of the range on my buy, I don't want to get in when we're overextended. I need structure to form. And what I mean by that is, I will talk about this in the next video, is I need, maybe like price indicating we're going to stay above this range, because more times than not, price is going to come back down and retrace that move and to look something, to look something like this. And I will not be interested in that because that could take 15 minutes, 30 minutes, an hour. Like I am very picky with my setup because this is what has led me to profitability. So we are overextended. And what I mean by that is I'm not buying from the bottom of this range. Like if I can't catch the buy from down here because this candle pushed up too much, then I'm going to wait. So I will not be entering overextended trades because more times than not, price is going to come back down. Another nuance that will keep me out of the trade is, so you have overextended, you also have overextended closures above the range. Meaning, let me just draw out what I had. You know, price pushed up, then you had your bearish closure, indicating, you know, now you have a stop loss to use, you have your bearish closure, and then you finally got a closure above. But I will stay out of this trade if price pushes too far up towards that area of interest where price may want to reject. Because if I'm targeting this area to the left, who am I to get in when price has already closed right at it? This is my area of break even or closing full or partials depending on how big this range is. I can't get in on this because we are so close to this range. Price is going to reject because it's rejected. Look at this. You've ranged and price is either driven off of it or driven or ranged from it. So I will not be entering trades. This is also another example of being overextended. I cannot. What I need to wait for is another entry type that I will show you in another video. So your cleanest breakout is going to look something like this. There's two options. There's two entry points on a breakout. Mostly all your trades, it's either the current candle high or the previous candle high. And I showed you the current candle high. Now I'm going to show you an entry on the previous candle, or on the current. I already showed you an entry on the previous candle high. Now I'm going to show you an entry on the current candle high, because if you can take advantage of wick fills, because I said wicks get filled in high times of volume and breakouts indicate volume, you can use that as an advantage point to go break even or something. So say we get a closure above and this wick is all the way up here. Say it looks something like this. Instead of getting in on the break of this high right here, you can get in on the current candle high after it creates its bottom wick. And what that's going to look like is price is going to come down, you know, price is going to create its high, but it's going to kind of pull back a little bit. And once it flips, you can get it, you can have a buy stop set on the break of this high right here to go target this wick fill. You can have a buy stop set right here to go target this wick fill as like a break even or as a close full, depending on how big the wick fill is. You can target this area right here. And when price came down, after creating its high, I'm now going to set a buy stop, because if price breaks this high, more than likely you're going to get a push to go fill this wick, because most all candles fill wicks, either whether you're bearish or bullish. And so I'm going to have either my take profit or my break even or partials right there. And that is another way of having management and entering on the current candle high rather than the previous candle high. If there's a wick to fill that I use, like if the wick fills like 25, 30 pips, I will for sure get in on the current candle high if price action allows me to get in. But if the wick fills only like 6, 7 pips, there's no point, because price could maybe fill 75% of that and then just reject, you know? And so wick fills are also another way of managing trades. And what that's going to look like is, you know, you're going to be closing profits right here or going break even or closing partials. And so that is what a breakout looks like. Same thing goes for a breakout to the downside. If we're bearish, I will be doing another video on how to help yourself avoid fake outs. You can't avoid them forever, but you can help yourself by not getting in when a fake out could occur. Breakouts work, you know, if it's correlating with higher time frame candles, 4 hour, 1 hour, 30-minute. And so this is an intro video to the breakout. And like I said, this applies to being bullish or bearish. And yeah, I will be creating my next video. The next video will be a celery play because it helps with your confirmation when a breakout occurs.